With corporates focused on accessing markets opportunistically and maximising issuance windows, the US private placement market continues to offer the greatest execution certainty and optionality for high-quality Australian issuers seeking tenors beyond 7 years. Maturities of 5 to 7 years remain the sweet spot of the Australian debt capital market. But the number and volume of 10-year tenor note issues by high-rated corporates in the Australian debt capital market has increased notably in 2017. However, the prospects for successful execution of extended tenor transactions in less accommodative market conditions remain uncertain. In contrast, the US private placement market, consistently recognised as one of the most resilient debt capital markets globally, has a solid record of operating through periods of global volatility. The US private placement market facilitates funding diversity for first-time and infrequent issuers, delivers competitive pricing for smaller and unrated companies of the right credit quality, even if they're subscale for the public bond markets, and offers structural flexibility, attractive both to larger rated corporates with access to public markets, as well as to less seasoned borrowers, through longer tenors, volume optionality, and deferred funding arrangements. Whereas public debt capital markets generally favour benchmark issues, US private placements can be structured on a bespoke basis to facilitate issuance of a number of small tranches of notes, having distinct maturities. This optionality, facilitated through US private placement investors' lesser requirement for liquidity relative to investors in public bond markets, is a silver bullet for low-volume issuers seeking to manage their maturity profiles to ensure a balanced portfolio of liabilities. At the other end of the spectrum, Ausgrid's debut US private placement issue earlier this year, at $1.9 billion, the largest ever by an Australian issuer, highlights the volumes achievable for quality infrastructure assets. And US private placement investors' willingness to offer deferred funding provides issuers with further flexibility. US private placement investors are demonstrating greater flexibility in relation to transaction structuring in an effort to differentiate their bids and maximise their final allocations. In particular, US private placement investors have become increasingly accommodating of local currency denominated funding structures. We've seen a pronounced increase in both the number and volume of Australian dollar denominated private placements. In a number of transactions, significantly sized Australian dollar denominated tranches have achieved competitive pricing outcomes through the involvement of traditional US private placement investors with natural Aussie dollar funds to deploy, as well as Australian institutional investors, including both superannuation funds and fund managers. Natural Aussie investments enable sophisticated investors either with Australian dollar denominated funds to put to work or the ability to carry the currency risk to access long-term, geographically diversified exposures to strong credits in a jurisdiction offering legal certainty. Traditional US private placement investors indicate that the capacity to invest other than in US dollars facilitates increased deal allocations, and long tenor debt instruments issued by stable, highly rated corporates and infrastructure issuers are attractive to Australian institutional investors, as the 2.3 trillion Australian dollar superannuation industry, long overweight on equities, steadily increases allocation to fixed income products. Natural Aussie note transactions also offer significant advantages for issuers. A substantial majority of Australian investment-grade corporate issuers have a preference for Australian rather than US dollar denominated funding, and natural Aussie note tranches allow companies to access Australian dollar denominated funding in both fixed and floating rate format without relying on cross-currency swaps. Like other US private placement notes, natural Aussie notes require payment of a make-whole amount in relevant circumstances. However, the issuer is not expected to cover any amounts associated with swap breakage at the time of paying a make-whole amount in respect of natural Aussie notes. In contrast, net losses are required to be paid in connection with relevant prepayment events in relation to swapped notes, that is, Australian dollar denominated notes in respect of which the relevant investor has entered into a currency swap. In addition, US private placement investors that do not have natural Australian dollar funds to deploy are increasingly willing to enter into currency swaps in order to be able to lend to issuers in local currency. Most US private placement investors are highly rated and can execute swaps at rates more competitive than those available to a BBB rated corporate. And over the last year or so, investors that have been executing swaps for some time have been willing to cover riskier names and longer maturities. The pricing credit US private placement investors are willing to give issuers for covenants and security offers further advantages relative to public markets. US private placement investors have the experience and capacity to recognise the benefit of covenants, whose value is often underestimated by public market investors. With significant credit analysis competencies in-house, US private placement investors are also better equipped to evaluate secured debt and amortising debt structures, as are particularly relevant in the context of US private placements by infrastructure issuers. Covenant and security packages required by US private placement investors are tailored to ensure that their notes stay at the top of the capital structure and that they have a voice if the issuer's business changes. Investors are increasingly requesting the protection of an anti-Cookson clause. This is particularly the case where the terms of US private placement notes allow for the incurrence of secured debt or subsidiary debt and guarantees in a structurally senior position to the notes. Anti-Cookson provisions are drafted to ensure that the USPP notes cannot be primed or subordinated in the capital structure by additional debt incurred following the note issue. An anti-Cookson clause thus precludes the issuer from using the capacity under a priority debt basket to secure the issuer's primary facility agreement without equally and ratably securing the USPP notes. An anti-Cookson clause customarily applies only in relation to security or guarantees granted in respect of the issuer's largest bank facility agreement. However, anti-Cookson protection may potentially be extended to apply in respect of other secured debt. For example, where the commitment or principal amount outstanding under secured facilities and debt capital markets instruments in aggregate exceeds a relevant threshold. US private placement investors also frequently request a most favoured lender covenant. A most favoured lender covenant provides that any financial covenants that in the future are reflected in the issuer's primary facility agreement will be read to apply to the US private placement notes. Ultimately, the covenant package and other contractual protections required by US private placement investors seek to manage any deterioration in the credit quality of the issuer. For high-quality, stable issuers, US private placement covenants, which are generally structured to provide reasonably generous headroom, can fairly readily be managed over a medium to long-term horizon.